Let's get more insight into the numbers and what they might mean for interest rate hikes. And for that, we're joined by Ross Berman, the founder and chief investment officer of Green Owl Capital Management. Ross, good to have you with us.
Thanks for having me.
So Ross, last report, we had 38,000 jobs added, very dismal, revised to an even more paltry 11,000 jobs. Now we come in with a blockbuster 270,000. What is going on? What's your main takeaway?
Yeah, so my takeaway, I think is a little bit different than most and how Wall Street received it today. On the surface, and I guess you could say quantitatively, 287,000 jobs is quite a good number, especially if you're someone concerned about what we had last month and that dismal number, as well as just recession fears that have generally creeped into the market. But if you kind of peel some of the layers of the onion back and you look at it from a more qualitative fashion, what you're going to see are some concerning things. What you're going to see is that 35,000 jobs that were created came from the Verizon strike and those workers coming back into the labor force. But more concerning, or very concerning, I would say, is that 50% of the jobs that were created were actually minimum wage jobs. And that's something that did not get a lot of press today. And that, of course, is seen in the flow through to average hourly earnings, which you guys highlighted, which was only up 0.1%, missed Wall Street expectations of 0.2%, and I would argue is quite a concerning piece of the puzzle that really needs to be focused upon.
So we're seeing that wage growth really isn't really happening in a substantial way, and that it's really minimum wage jobs that are being created. I mean, what impact do you think this will have on consumer spending, which is the main driver of our growth?
Sure. Look, I think you've seen a lot of dismal data over the last, few weeks and few months, and I think that's part of the dilemma that the Federal Reserve is having as we currently speak. So until you see that nominal wage growth increase to what I believe is the 3.5% or 4% level that really kind of indicates a more healthy economy, I personally think the Federal Reserve has to sit on the sidelines, and I don't think you're going to see the general economy recover to the level that it should until you start seeing those numbers.
So this is all good news, though, for the equity markets, though, isn't it? Because it's a risk-on
environment. Yes. Well, clearly today there was a big risk-on, but today was quite unique, and not only did equities rally, but it was a very unique day where you also had treasuries rally, you had metals, specifically gold rally. I would argue the cross-correlation between these asset classes was quite interesting today, and actually today, 497 out of 500 stocks on the S&P were up, which was the second highest ever recorded. So clearly it was a risk on, but I do think people need to, maybe take a breath over the weekend and evaluate what some of these underlying tones mean.
Well, we had a lot of economists now revise their forecasts for the potential of a recession. Barclays saying that it's now dropped to a 20 to 25%. JP Morgan saying that their model shows a 37% chance of a recession over the next 12 months. What do you think?
So, look, I think it's hard for the experts to get this right.
Well, they don't get much right.
Yeah, correct.
Including the jobs forecast.
Yeah, if it was easy, everyone would do it and do it well. But yes, so I saw that JP Morgan number come out today at 37%. A couple of weeks or days ago, actually, Deutsche Bank was out actually saying there was a 60% chance of recession. What I do know is we're 7 years into an economic recovery. And statistically, to go another couple of years without a recession seems a little bit unique, but we are in unprecedented times in terms of central banking policy on a global level, so on and so forth. So I think it's difficult to predict, but I think I fall somewhere in that level of, that 25 to 50% area over the next 12 months.
Well, then what should the Fed be doing? Because many people say that this is the time that perhaps the Fed does need to raise rates in order to have some kind of weapons in its arsenal should a recession hit. Because at the moment, they've got nothing to work with. They have no room for maneuvering. What do you think the Fed should be doing in light of this?
Well, I think what we see is that somehow the Fed or central banks always seem to have some ammo, but I think they need to wait. I think they need to be cautious. I'd be much more concerned about them hiking prematurely than waiting for inflation to tick up a little bit and then act. And again, for me, one of those main bogeys is that wage growth. And until I see that 3.5 to 4% wage growth, I'd like to see the Fed sit tight. And I think they're doing the right thing by sitting tight. Let's get another couple of months of data out there. Let's see what it looks like. Let's see if there's some follow through with some job growth. And then we can make, I think, a more informed decision.
The Brexit a big factor in the Fed's decision leading up to this and, of course, going forward. But it seems as though the markets have shrugged it off pretty much. Markets coming back to their pre-Brexit levels today. Is the Brexit fallout pretty much done as far as the equity markets are concerned here in the U.S.?
Look, I can't figure out a possible way that it is. I think the unknowns are still out there. Obviously, there's going to be a lot of maneuvering inside the UK as well as for the EU, and a lot that needs to be figured out. And I think that can have ramifications far beyond, Europe as well. So I think I'm extremely confident that we're going to see more volatility because of either Brexit or the reactions to things that are going to be reactions to this, really historic event that we've seen just occur.
All right, we're going to have to leave it there. Thanks so much, Ross Berman, founder and chief investment officer of Green Owl Capital Management.